Let's introduce Andy Posner and Kevin Egolf. I had the pleasure of meeting Kevin at an event with Gavin in New York last November. And since then, we've spoken quite a bit. And so I'm really happy to have them both, Andy and Kevin, here today to talk about the very creative work they're doing with capital, putting poverty out of business, which I thought was the best tagline I've heard in a long while. And all the change that they've been able to leverage just by the creative use of finance.
Absolutely. Yeah. Thank you so much for the opportunity. Really excited to talk about our work. So just by way of background, I'm Andy Posner. I started Capital Good Fund 11 years ago now. And the story of how I came to do it is a little bit interesting. So I was in 2008 when the financial system collapsed, getting a master's in environmental studies at Brown, where I was studying financing mechanisms for clean energy, things like property assessed clean energy financing, or PACE. And I don't have a background in financial services. My bachelor's is actually in Spanish. So I was really fascinated by how a financial instrument could enable someone to invest in solar or not. And then two other things happened. So one, as I mentioned, the financial system collapsed, and I didn't quite understand why, or didn't see the connection between banks going under and the lives of low to moderate income people, which was sort of my other area of interest and concern was marginalized communities. So I started learning about the financial system and its connection with racism and gender issues, and stumbled on the issue of payday lending, pawn shops, rent-owned stores, and the like. And then I also around this time learned about Muhammad Yunus and international microfinance. So with all that swirling in my head, I decided to do a series of focus groups in Providence to try to understand what are the issues that lower income folks, particularly Latino community in Rhode Island, was facing in the aftermath of the financial collapse. And when I heard about payday lending, I sort of assumed that there was an existing alternative to, in Rhode Island, a payday loan is at 261%. And I learned that there really was not any alternative. So decided to start Capital Good Fund to try to serve as that alternative. And, you know, poverty is a big business. Predatory lending is about a $200 billion year industry. So that's where that tagline of putting poverty out of business comes from. So that's just a quick background. Kevin, you want to introduce yourself?
Absolutely. So I'm Kevin Egolf. I'm the Vice President of Investor Relations at Capital Good Fund. I just crossed my 1-year anniversary a few months ago with Capital Good Fund, but I've been in the sustainable impact investing space approaching 10 years now, and I joined Capital Good Fund because I was just really attracted to the mission, as well as the huge opportunity I see to really use creative financing, both on our deployment strategy with our equitable financial services, which we'll obviously dive into, but as well as our fundraising strategy. I mean, to me, impact investing, has so many parallels to conscious capitalism. It's just on a different side, right? Instead of being the consumer or the business, you're using your resources for your savings and creating good and positive outcomes. Yeah. So I was just attracted by some of the fun things we're doing with raising capital from investors and how we're doing that, and the opportunity that creates to make material changes, for our clients, for the way we think and how think and actually do business.
So the basic problem you guys are trying to you guys are working on, and that you're doing a great job with, is basically the giving people an alternative to like a pawn shop or payday lender or something like that, where if they need some money for something's come up, their car died and they need another one so they can get to work or something, that they can reach out and go to you guys and get a small loan, maybe some coaching and stuff on financial things if they need it, and get over that hump so that they can keep on with their lives, right? At a much more reasonable rate than they would get someplace else, right?
Yes, exactly. So we're what's called a community development financial institution, which is a U.S. Treasury designation. And what's interesting is that there are probably about 500 CDFIs across the country that do lending. Most of them do small business lending or affordable housing or community facility financing, like charter schools. Very few of them are in the consumer loan space, which is unfortunate given the size of the problem that I mentioned, $200 billion. And so we are meeting a very big need, and the loans that we make range from $300 all the way up to $25,000. And there's a business and an impact reason for that broad range. But the loans are most commonly used for things like vehicle purchase, repair, or refinance. We do security deposit loans. We have a payday alternative product, although it's not a payday loan. It is an installment loan, like all of our loans. We also have a third of our portfolio consists of our double green energy efficiency loan. And then we also do immigration loans for costs associated with citizenship, green card, family petition, that kind of thing. And then in late March, we rolled out a crisis relief loan, which took some existing loan features, added a couple like a built-in deferment period and a lower rate, so that it could really respond to the need in the community during this pandemic. And then as you noted as well, we do one-on-one financial and health coaching, not as a prerequisite to getting a loan, but as a parallel track to provide additional support to people.
About how many people have you worked, how many customers or, people have you helped out or worked with so far? Any idea?
Yeah, so we've done about 5,800 loans for coming on $12 million.
Okay.
We've had about 1,800 people go through our financial coaching program over the years. And we have about 2,200 active borrowers for $5.8 million or so. So our loan portfolio has grown significantly. In 2015, we only did $300,000 worth of loans. And last year we did $3.1 million. So, we're a very high volume, low margin lender. The people that we lend to predominantly of color, predominantly women, 90% low income, no or poor credit. And despite them being supposedly not creditworthy, our repayment rate's 95%, which we're really proud of. And the average interest rate we charge is only about 13%.
Which compares to, predatory lenders, which can be, some payday lenders can be upwards of effective interest rates of 800%. More commonly, you're going to see payday lenders at 200 to 400%. You're going to see other predatory loans in the high double digits, whether it's a pawn ticket, rent-to-own shops. Those can be 50 to 100%. So our products are night and day, substantially better for our clients based on the interest savings alone. But also from an impact perspective, importantly, we report to all three credit bureaus. Most of our, and I use competitors in quote because I don't even think we can consider them a competitor. They only report if you stop paying. So you only have a risk. You borrow from them, and your biggest risk is damaging your credit, and there's no upside. With us, given our repayment history, with our clients, giving them loans that they can't afford by actually doing an underwriting process, and then reporting to all three credit bureaus, we see our clients have credit score increases, upwards of triple digits on average. So, we importantly are saving them money, but also giving them economic uplift opportunity by building that credit score and allowing them to enter the financial mainstream as their credit score increases and as they get more comfort around using, appropriate financial services.
I saw that somebody asked, what do we think accounts for the high repayment rates? I'd be happy to speak to that. So, the first thing I always say when someone asks about that is that we do not rely on what I call magic algorithms. I feel like there are a lot of fintechs out there that tout their data scientists having come up with this formula that somehow correlates variables with risk. And we don't think that's particularly feasible. If you don't take the time to try to pick apart what's driving a person's financial situation, then you're just going to end up falling back on metrics like credit, which are imperfect proxies for risk. So the way that we underwrite is based on, first, a residual ability to pay test, which is obviously, it seems obvious, but the payday industry actually has pushed back on any requirements to do ability to pay tests. And in fact, the Consumer Financial Protection Bureau had promulgated a rule to require payday lenders to do that. And then under the current administration, that was rescinded. So that's the first thing we do. The second thing, though, and this is really the most important factor, is because our borrowers have an average FICO of about 590, we instead underwrite predominantly based on banking history. And the reason for that is that we require ACH withdrawal for the monthly loan payments. And so what we found is that there are a lot of people who have had issues with their credit in the past, could have been a divorce, domestic violence, an illness, whatever, but who now have an active account that they're managing well. And that reflects how they manage their money in real time. And their credit just hasn't caught up effectively. You can have a 400 FICO score heading towards a 700 or vice versa. And if you don't take the time to actually look at the data, you won't be able to tease that apart. And then we also look at some intangibles, like, if they're referred to us by a domestic violence agency, we know to look for signs of financial abuse and tease that apart. But then the other really important factor is how we work with people post-closing, right? That is not the end of our relationship. One thing we're really proud of is that if you Google us, you'll see we have over 310 reviews with a 4.8 out of 5 rating, average rating. And that's just testimony to our a really good customer service. But we will work with a client through whatever they're facing. And COVID-19 has given us the opportunity to really demonstrate that. At our peak, we had about 18% of our active portfolio in some form of deferment. And as a result of that, we have not particularly seen a spike in defaults, and our portfolio risk has stayed pretty steady. And a lot of those clients have now rolled off of deferment and are back to paying again, and others have asked for an extension. But that is really important just to our model, is we don't just responsibly underwrite, we responsibly service. Somebody asked about financial literacy. So we offer it. As I mentioned, it's a parallel track. So we very intentionally do not require that somebody do financial coaching to get a loan. And there are a couple of reasons for that. The first one is actually philosophical. So we predominantly, our underlying philosophical attitude is that poverty is a function of not having enough money to manage, and not a function of a lack of knowledge of how to manage money. Absolutely, there are people who are low income who don't know how to manage their money, but that's true of people across the income spectrum. And in fact, the less money you have, the better you have to be at managing it, just to avoid starvation. So that's the first thing philosophically. We don't want to force people to go through that. And then practically, and from a competitive perspective, were we to require people to do financial coaching to get a loan, that time delay would make us make it hard to compete with a payday lender, which can do a loan in 5 minutes. Yeah. Also, I'm not convinced, and I have not seen any data or evidence to show that requiring coaching to get a loan improves your repayment rates. So we strongly encourage people who have a loan with us to avail themselves of our coaching. And we have a lot of people who come to us first for coaching and later apply for a loan. So that's sort of how we think about coaching and lending.
I guess I'd say that, we had, in our company, we had 330 employees, and maybe a third of them, were only making maybe $15 to $20 an hour or something like that. And, they were raising families, doing stuff. Sometimes they were single parents, and I was always amazed. It was just, to me, it was like they were wizards. Whatever they were doing to make ends meet and do that, they were just incredible. So, I'm kind of going, I like what you were just saying. It's not, it's not necessarily the lack of being able, knowing what you're doing. A lot of these people do know what they're doing. They do it really well, but they've hit some something's happened, like you said, domestic violence or some other issues come up in their life, and or some sort of emergency, some parent in Guatemala or something like that all of a sudden needs something, and there's a crisis, and so
Right.
we, as a company, we used to help people out, and I would loan somebody $500 or $1,000 or something, and sometimes I just loan them money personally, and most of the time I got it back. So but
Yeah.
it just because somebody would come to me and go like, oh, I got this thing and I hate to come to you and talk to you about this, but I don't know what else to do. And it's like, yeah, okay, don't worry about it. And, yeah.
To put some factual context around the exact experience that you've had, Gavin, and this is a commonly cited statistic, so some of you may know it, but 40% of American households cannot handle a $400 expense without either selling something or borrowing money. So, I'm sure some of you have had cars break down, just, and what was the bill of that? A lot of times that's over $400. So if all of a sudden you have to choose between, putting food on the table or repairing your car or juggling something around because you need your car to get to work. Unfortunately, most of us don't live in areas of the country where cars aren't required. That requires a lot of financial juggling, and people do this all the time, and they make ends meet. And so increasing the opportunity for those individuals to have an equitable option rather than pay extractive fees and expenses in these emergency situations only further increases the chances of creating economic, upward mobility.
The key difference between us and typically, it's very common for someone to cite that statistic and then go on to talk about how people need to do a better job of budgeting, or you'll often hear the proverbial, if you didn't have a coffee every day, then you would, at the end of the year, save, $1,000 and you'd be on your way. And if that is the attitude that drives your work, that is going to lead to a certain type of program delivery. And unfortunately, a lot of financial coaching and a lot of socially minded programs come from that place of judgment, and we don't. So we believe that dynamic is largely a result of forces outside of people's control, right? A lack of affordable housing, a lack of equitable credit, access to credit, a lack of upperly mobile jobs. And that really drives our DNA and how we treat people, how we design our products and services. And that is definitely a key component of our success and growth.
How are you guys financed? Where do the funds come from?
Yeah, that is a very good question. We're very unique because we are a 501c3 tax-exempt nonprofit, and so like any nonprofit, we receive grants and donations from individuals, financial institutions, foundations, the U.S. Treasury, etc. We also, though, are a social enterprise, so we charge interest, and we are charging an interest such that by 2025, our goal is to be self-sufficient off of that earned income. Last year, we were 30% self-sufficient on a cash flow basis. And just to give you a sense of scale, we had 3.3 million in total revenue last year, so a third of that was earned. And then the way we capitalize our loan fund is by borrowing. We're not a bank, so we don't take deposits, but we borrow from, HSBC and Discover Bank and faith-based investors and individuals. We have RIAs that refer to us. And then the fourth thing we have that's very unique is we have a debt offering that we're running through a subsidiary of ours that we can get into, but it's another type of impact investment vehicle that we've created, through which we've raised about $5 million. So in late 2015, we kind of completed a lengthy business planning process. And the goal of it was to say, what will it take for us to achieve our mission and become self-sufficient? And so our goal is to do that by 2025, like I said, and that was when we rolled out this investment vehicle that allowed us to raise this 5 million and use it for basically growth capital. So we've more than doubled our staff. At the time, we were only in 1 state. Now we're in 5. And a sneak peek, in about a month, we're going to be rolling out in our 6th state, which is Texas. So we're in a very exciting place organizationally.
a question from Matthew. He says, what is the acceptance rate of loans? Effectively, are you doing a great job of underwriting, or are the people that are applying inherently more creditworthy than they appear by more traditional metrics?
Yeah, excellent question. So we have a lot of data to inform how we underwrite, and we shoot for and have maintained a 40% approval rate. It varies a little bit. So for example, on the crisis relief loan, because of how we've structured it and because of there's grant funding kind of backstopping it a little bit. So we have about a 48% approval rate there. But that for us is the right mix of portfolio management and impact. We're one of the ways we're going to increase that though is that we just completed a tech overhaul, and we've built our pre-screening tool into the workflow. So you have to do that before you can even apply. So hopefully fewer people will go through the process if don't meet our basic eligibility criteria. But no, we're definitely not just self-selecting for people that would be a good credit risk anyways. Like I said, the average FICO is 595. 20% don't have a FICO at intake, predominantly of color. We serve a lot of immigrants, including undocumented folks. So definitely people who otherwise are not getting access to affordable credit.
And to add a little bit and use that to segue sort of into our business model, Andy had mentioned, the range of loan sizes from 300 to 25,000 and different uses. As a social enterprise and as a nonprofit, we realize that the profile and the need of a borrower looking to borrow $300 is very different than that of someone looking to borrow $15,000 for a vehicle, or for a moderate income homeowner to make an energy efficiency improvement within their house. And so we think about the different loan sizes very strategically. We acknowledge that we're never going to make money giving out $500 loans. So from a business perspective, we think about the larger loans cross-subsidizing our smaller loans. And we know that the smaller loans are having sometimes, much more meaningful impact for the individual family or household, whether that's, catching up on rent and utilities so the electricity stays on, so the internet stays on, so that their kids can still do their remote learning. Fortunately, there are some protections right now protecting households like that, but that's, one example. And so we look at those loans very differently. All of our loans obviously have tremendous impact, but we allow for a little bit less performance on the smaller dollar loans, knowing that the money is going to have that dramatic impact, and are a little more stringent on our larger loans, knowing that that's really where we're going to earn our money, and that's really where the largest risk of capital is going to be. We also, as a nonprofit, get a lot of grant funding to help assist with some of our smaller dollar loans, and we can think about that differently. But there's a lot of strategy that we think about from an impact and a social enterprise perspective going into all the development of what we do and our scaling plan to reach self-sufficiency.
Paul is asking, what is the primary way customers get to know about you?
Yeah, it's a good question. I mean, we're really a fintech. I mean, we have 38 employees spread across 5 states, mostly in Rhode Island, but we only see clients in person, well, pre-COVID in Providence. So, we don't have walk-in clients, in other words. The single largest source of referrals and inquiries is just organic Google searches and Google AdWords ads. Also, United Way's 211 helpline across our footprint is a big driver of referrals. Word of mouth, earned media. We actually are fortunate to have a PR firm, and so we've gotten exposure nationally on the Wall Street Journal and locally, and Providence Business News and Miami Herald and the like. And then for some of our products, we have a business-to-business model. So for example, with our immigration loans, most of those referrals are coming from immigration attorneys that we've vetted. For energy efficiency loans, similarly, the referrals come from the energy contractors. So it's kind of a mix. And then we do have a lot of community partners that we work with that send a decent amount of traffic. So domestic violence agencies, like we talked about, other types of social service agencies and the like.
What are people generally doing with the energy efficiency loans? What sorts of projects are they up to?
So in Rhode Island and Massachusetts, it goes up to $25,000. It's through the heat loan program, if you're familiar, which is actually it's with the utilities,
Yep.
and it's interest free to the homeowner, and then we get paid a buy down up front by the utility. We're the only non-bank lender in the program, and that comprises a third of our active portfolio, and it's the net all-time net charge-off rate's about a half a percentage point. It's a very, very safe product, and we love it because the impact is huge. And it's mostly bread and butter things. It's new boiler, high efficiency boiler or boiler replacement, insulation, ductwork, sealing. We've done some heat pumps and the like. What's really exciting, and this is also a sneak preview, we haven't announced this yet. Next week, or sorry, in 2 weeks, we're launching this product, which we call Double Green Loan in Illinois. It'll be our first time offering it outside of the utility program. We're really excited about it. We're partnering with a nonprofit called Elevate Energy. And what they're going to do is they vet the contractors, and then they're going to vet the scope of work for each project. And then we're going to underwrite the applicant and fund the loan and service it. And because we're working with them, we have a lot more flexibility with the program parameters. So we're going to be able to include solar PV, solar hot water, and things like that. But I still think it's mostly going to be bread and butter kind of weatherization. I'll note as well, though, that it will include home health and safety, asbestos removal, knob and tube wiring removal, if there's mold remediation, anything that needs to be done to unlock efficiency measures or solar will be included in the loan.
James is asking, if someone wanted to invest $100,000 for 3 years with you, what would you pay as their return?
So we have, as Andy mentioned, open for investors right now, our impact offering through our supporting organization, Social Capital Fund. So that's open to accredited investors anywhere across the U.S. that are interested in supporting our mission. I'm happy to share after the call. There's a rate table that we have that the return depends on the amount and the duration. So we allow investors to invest for 3, 5, or 7 years. The minimum investment is $5,000, and so the return, the annual interest payment on that would be 1.5% on the low end to 5.5%. A 3 years at $100,000 would be 2.5%. If the investor was willing to put it in longer term, we obviously encourage investors to think longer because that gives us a little bit more flexibility to execute on our growth plan. The returns can go up to 3 3/4 for 5 years or 5% for 7 years. So most we obviously have a wide range of investors, but we see most people investing for 5 and 7 years because of the more attractive rates.
And I'm just wondering how you guys gauge success in your particular niche. What you service so many sort of fragmented and needy parts of the market, but what are your KPIs as such?
Yeah, so I'll answer that in 2 clear ways. The first one is just to reiterate, our mission is to create pathways out of poverty and advance an inclusive green economy. So we're looking at both of those issues since they're so connected. We have 3 measures of success on the impact side. So the first one is the use of the loan itself. So we think of that as often the primary impact. So for example, a domestic violence survivor getting a loan for security deposit on a safe, affordable apartment, an immigrant being able to avoid deportation, et cetera, et cetera. That's what we think of as our first impact. The second impact is the savings on interest and fees. We estimate that in aggregate, we've saved our borrowers over $4 million. in America, the average family that makes $25,000 per year spends as much on financial services, namely interest and fees, as it does on food, about 10% of income. So if we can cut that in half, that's food on the table. And I mean, if you take out a $300 loan with us compared to a Payday loan, you're going to save $500 of interest right there. And on an auto loan, if you compare us with a buy here, pay here, you can save $5,000 or more. I mean, for example, in Florida, you can get an auto loan at 28%. So if you get that same one with us at 13, you're talking about a $7,500 savings roughly. And then the third impact, as Kevin was talking about, is credit. Reporting to the bureaus, building up people's FICO score. And then from the social enterprise kind of business perspective, we're really tracking, you know, kind of our cost of funds, our repayment rate, our spread, our earned income. And then we track really hard on our Google reviews and online ratings. Like, you know, whenever I have a new employee start, I talk to them about focusing on mission, on customer service, and on business. So basically, you know, revenue, efficiency, and that kind of thing.
There's a question coming in privately asking if you have any plans to expand to New York.
We don't right now. And it's, you know, we get a lot of questions about expansion to different states because we are so unique and so needed. The challenge for us is that, well, first of all, once we're in Texas, we'll be in 6 states, including, you know, Florida and Texas and Illinois, which are all pretty big. So we don't really need more markets in order to hit our scaling goals. And while, you know, the recurring cost of being in a market is fairly low for us because we're online, the upfront costs can be pretty high to get the lending license and the like. And New York is a state that doesn't have brick and mortar payday lending, so there's a little bit less urgency in terms of the need for us. So really the answer I give whenever someone asks about a state is we have too much going on right now, but it's something we could look at middle of next year. We would probably need at least a $500,000 grant to be able to justify the time and effort to undertake that expansion.
David is asking, can you talk more about proactive loans where the client wants to open a small business and perhaps get into owning a small franchise?
Yeah, so we're exclusively a consumer lender. We don't do business loans. But one of the things that's interesting is that historically about 5% of our borrowers list their primary source of income as self-employment income. So a business owner, it is not uncommon for a business owner to come to us for a personal loan, and they can, in theory, use it on their business, but we underwrite it based on their personal finances. And you know, there are other CDFIs that specialize in the small business lending space.
Yeah, we've really tried to carve out a niche on consumer loans for a variety of reasons. One is we see that being a huge area of need that's unmet. 2, we've developed, you know, efficient systems. We've invested in these systems to handle and process these types of loans. So that's really where we're focusing our effort and going to continue to focus our effort for the foreseeable future. But yeah, there is a lot of crossover for really small self-employed individuals. You know, if you're funding a vehicle for that individual to drive to the workplace, you know, where they're performing whatever, whether it's carpentry or and maybe a trade, you know, that's money that they're then able to invest in their business, whether it's a licensing fee or whatever it might be. So there is a lot of factors that know that we are supporting small businesses indirectly.
Awesome. Paul is asking, since it's a startup business, what is one thing you wish you did differently, if anything?
Well, hopefully we're 11 and a half years old now. So I feel like we're out of the startup phase. We're kind of in the growth phase or whatever the next developmental phase of a nonprofit is. One thing that wish I'd done differently. You know, I think that if we could have gotten started sooner on doing the financial modeling for scale, The problem is that until we got more traction, it was hard to raise the funds to really carry out our business model. And so this is a problem that's endemic to many nonprofits, is that you can raise money to run a small program, but not to make the investments in scale. You know, I wish just in general that as a fintech, we could have raised money sooner to invest in technology. You know, I think I mentioned earlier that we just completed a $250,000 year-long tech overhaul. I wish we had done that 5 years ago. We just didn't have the money. And I think that's just something that from in the grant making community needs to be rethought a little bit, is how do you build the capacity of high impact nonprofits to scale that impact. So I guess that's another way of saying I don't really regret a lot of anything other than wishing that we could have brought in, had the money available to invest in things sooner. Because I think we could have grown, we could have been much bigger by now. But we're in a good place now. So.
Spike in demand in the COVID pandemic?
Yes, we have seen a tremendous spike in demand. April, May, June, July were 4 consecutive months of record loan volume. And that was driven by the crisis relief loan, which I mentioned before it's $300 to $1,500, 3-month deferment period, then 12 monthly payments. The interest rate's just 5%. And it was really important that we launched that, both because people needed the liquidity in the capital, and because you know, not as many people were buying cars, particularly for the first 4 months or so of the pandemic. So we saw a decrease in volume on those products, but just a massive increase. We're coming up on 700 crisis relief loans financed already, and you know, the need for it is significantly greater. And there's been a second wave of demand when the enhanced unemployment that people were getting, the $600 a week, expired at the end of July. And that really put people into additional difficulty, especially since it's not like businesses have magically started to open again. So we expect that there's going to be a need for this well into next year. One of the things I want to mention about the crisis relief loan that we're really proud of is that we recognize that making these loans in this moment is just going to be a lot riskier than normal. And so what we did was we've raised a grant-funded loan loss reserve, which we don't normally do. Normally, we just cover losses through the spread. And then for every dollar that we raise in loan loss reserve, we lend out up to $3.50 of our own capital, which means that if defaults don't exceed 28.6%, we have no principal at risk. Moreover, while we don't tell clients this, I think for obvious reasons, if someone can't pay, we can actually just forgive the loan with the grant money. So we're not ultimately going to harm people's credit. And so this allows us to take a little bit more risk. We're not expecting a default rate that high. We're targeting more like 15% for this product. But the philanthropic response has been phenomenal. I mean, it's a really powerful model, right? It's leverage, it's sustainable, it revolves, it gets capital into people's hands, it supplements existing programs. But also keep in mind that a lot of the stimulus programs exclude people like immigrants from accessing it. And so for a lot of people, we're one of the only sources of liquidity during this crisis.
You mentioned the 95% repayment rate. I'm just curious, that seems pretty good, but I'm wondering how that compares to, say, like a commercial bank who's dealing with the regular structured loans on commercial rates, how that compares.
Well, yeah, I mean, that's going to be a little bit high for what, you know, a Bank of America is going to want to see. I'm going to guess they're probably in the 2% range or something along those lines. But the better comparison point is a credit card company. You know, because that's a little bit more akin to the population we're serving. And I'm actually not an expert on credit cards. I believe they're closer to 10%, but don't quote me on that. But we're much lower than what they experience. Certainly, though, if you look at the tranche of people that we serve, the credit score range, you would expect a delinquency plus default rate that's closer to 25%. And if you look at payday lenders, their default rates are 30 to 50%. Now, the reason they can get away with that is because if they charge 300% and lose 50%, they're still making a lot of money. But yeah, our portfolio far exceeds what you would expect given the credit and income profile of our borrowers.
So one of the reasons why you ended up in, you know, Illinois and Texas and things like that is because somebody stepped in and really wanted it there, right? And so basically gave you a big grant to execute that kind of thing. Am I right?
Yeah, well, we did a 50-state analysis back in 2015, and 3 of our top 5 markets were Illinois, Florida, and Texas. And that was because of the size of the market, the size of the predatory loan industry, the regulatory landscape as it pertains to us and how hard it is to operate in the market. And then also we focus a lot on immigrants, and so the immigrant market. And then yes, so JP Morgan funded us to go to Florida first. We did that in late 2016. JP Morgan then gave us a grant to go to both Illinois and Texas, and a family office in Illinois invested $1.25 million in our impact vehicle. And so that allowed us to go into Illinois first, actually. Texas, it took us a little bit longer than we thought to get the lending license. It was surprisingly onerous process, but yeah.
Marna is asking if your customers need to be citizens or green card holders.
They do not. They do not. We don't ask, don't tell, but we definitely, you know, are confident that we have a decent amount of clients that are undocumented. Some of them kind of by definition because they're applying for an immigration loan to get status. As long as you have an immigrant tax identification number, some way of verifying identity, it can be a consular ID, it could be, we're pretty flexible with that, and some way to verify income, then we can lend to you.
And Paul is asking, have you seen any reaction from the payday loan industry?
I think that they're too canny to try to go after us. Instead, so one of the reasons that people like having us in their state is that most states that have payday lending have a coalition of community groups fighting it. And every year when there's a bill that's proposed in Rhode Island, you know, it's been 10 years that every year someone files proposed legislation to cap the rate at 36%. Invariably at the hearing, the payday industry presents their case, and then some legislator who is, you know, views them favorably will say, well, what happens if we get rid of payday lending? Where are the alternatives? Right. And so that's why we're always great, because we can be pointed to as, yes, Capital Good Fund is here, they're ready to scale, they have an alternative. And the payday industry, like I said, is canny, and their messaging is always, we support having more options in the marketplace. So, you know, we have not gotten big enough yet to sort of scare them. We hope to do that. We think that in a state like Illinois, our presence is going to make it possible for in the next couple of years to convince the legislature to, you know, implement a rate cap and other consumer-friendly policies. Because again, we can come in and say, if you do this, people will have another place to go, and that's us.
Right. And just to add to some scale perspective, just to numbers were used earlier, but the predatory loan industry is $200 billion with a B dollar industry. You know, we did $3.5 million of loans last year. So at this point, we are still pretty small and have not gotten to the size and scale where I think people would start to, at least within the payday loan industry and the other predatory financial services, would really start to have concern about our presence.
Can you help me understand why it's so expensive to be poor in this country?
Yeah, I mean, I think a lot of it has to do with disinvestment and a lack of consumer-friendly regulation at the state and federal level. But I mean, it comes down to a lack of an affordable, affordable housing. The standard of housing is low. Mass incarceration plays a part in it, as does our inequality in our educational system, the tax code, which is becoming increasingly regressive in this country, and then as well the lack of access to financial services. I mean, that is a huge factor. I mean, we don't provide banking services, and unfortunately for many of our clients, if they have a bank account, they have one where they're paying monthly service fees and balance inquiry fees and overdraft fees, or they go to a check casher, or they go to a payday lender, or they use a prepaid card that has all sorts of fees on it. And often the prepaid card is less expensive. So it's a whole, one of the challenges is that we don't claim to be a solution to poverty on our own. We're a key part of a broader set of things that have to happen. Because the scale of the injustices, racial, gender, etc., is pretty severe, and it's a series of interlocking issues. And we're starting to get a little bit more active in public policy, thinking about how tax policy and voting rights and things like that impact our population. And we're even thinking at some point we may want to start what's called a 501c4, which can do a little bit more on the public policy advocacy side. We're a little bit more limited on it.
Just to add a little bit more to that, I mean, if you think about as an individual all the financial services that you use, and I'm assuming most people on this call are fairly well off. Your bank account, you put in $1,000 and you don't pay any fees. Your credit card you'll use and pay off monthly, even for some larger charges that may be luxury but may also be necessary. Each one of those dollars that a low income individual has to put forward, whether it's that interest fee, having the bank account, is a meaningfully more percentage of their total income, the less you make. So while some of those fees, you think about an overdraft fee of $25 or $35, whatever it might be, as being modest, that could be a very meaningful percentage of your weekly paycheck. And if you make a mistake, or your check doesn't clear, or something that's outside of your control, and all of a sudden you get caught in these additional fees, it can be extremely detrimental on the financial well-being.
So you mentioned JP Morgan a few times. Is it part of their sort of philanthropic perspective on the world to support organizations like yours, or is there a relationship there of some sort?
We get support from a lot of financial institutions through their Community Reinvestment Act obligations and goals. So we just we make a lot of sense for them as a strategic partner, from a PR perspective, from an impact perspective, from a CRA rating perspective. And I think they get what we do, and so it resonates with them. And we have a very good relationship with them. I mean, they don't just give us grants. They also connect us with different groups and resources. Whenever we launch in a new state, they help us in getting the word out and getting press coverage of the launch. JP Morgan hasn't made a loan to us, it's just been grants, but other financial institutions have done both. Discover Bank made us a $2 million loan in the form of something called an equity equivalent investment, which is basically just deeply subordinated unsecured debt. And then additionally, they've given us hundreds of thousands of dollars of grants over the years. So we have a lot of really great financial institution partners. Any other questions from the group? Yeah, go ahead.
I just say I think it's just amazing. It's such a great idea and such a great thing you guys are doing. It's just there's people who are trying to pull themselves up by their own bootstraps, and hardworking people, especially women, people of color, stuff like that. Maybe they were incarcerated, maybe they've got immigration issues, whatever. All these different things that are drags on them. On their attempts to get ahead and get their life sorted out. There's such a wonderful benefit for them. So it's great
Thank
stuff.
you. Yeah, and so I would say if people are interested in a pretty unique impact investment, Kevin's the guy to talk to. I don't know if we can put his contact info in the chat, but it's just
Sure.
Kevin@capitalgoodfund.org, or myself, I'm Andy at capitalgoodfund.org, and we'd be happy to talk about that. And then also, for limited time, we're continuing to raise money for the grants, donations for the loan loss reserve for the crisis relief loan. That's going to allow us to continue to leverage the funds and make those loans to people impacted by the pandemic.
Well, we're very pleased to hear your story, the way you support people of color and minorities in this country. You know, it's expensive to be poor in this country. I was amazed when I first arrived here how the predatory many people were to those that could least afford it. So I'm very pleased to hear, fast forward 20 years, that you guys are actively combating such a vast industry, you know, in a very creative way that gives financial assets and training and FICO scores to those that really need it. So, you know, I'm so pleased to hear about your good work and your contribution to the financial equity of our community. So if we don't have any more questions, I think we're going to close right on the top of the hour. Ali, was there anything else in the chat box?
Nope, that's it. Just a reminder too that we had a podcast with Andy, and that's up now. If you go to our website, it'll be on social too and in our email. So take a listen to that too. I saw you guys already have that on your website. You guys keep your website nice and up to date.
Thank you. We do.
Yeah,
Thank
great.
you. It was a pleasure to chat.
Thank you, everyone.
Thank you.